Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, everything you need to know in 90 seconds at 9 o'clock, with news global manufacturers are bullish, except perhaps in the US and China. But first, don't forget it's a public holiday in New York, so data flows from the US are few. However, there have been two factory PMI reports out, but they're not helpful. The highly respected ISM report said American factory activity rose sharply in June to its highest level in almost 3 years, suggesting economic growth in the second quarter gained some steam. But the market PMI was much more downbeat, reporting the same sector had its slowest rise in production volumes since September 2016, and that new order growth eased for the fifth month running. Take your pick. The Caixin PMI report for China was also not very encouraging, but that was also in contrast to the official Chinese survey. The equivalent survey in Australia was, however, very upbeat, as was for Europe and Japan. These mirror our own PMI surveys, which may be the strongest of the lot, and all contribute to a global assessment of manufacturing growth that is solid and steady through the second quarter, weighed down by the US perhaps, but upbeat in most other key places. In Hong Kong, China has launched its Bond Connect scheme that links China's $9 trillion bond market with overseas investors. Trading initially is northbound, meaning foreign investors are now able to buy and sell Chinese bonds. No launch date has been set for the southbound channel. It is the latest step in Beijing's efforts to liberalise and strengthen their capital markets. In the first 20 minutes of trading, about $300 million in trades were done, mainly by HSBC in the Bank of China. Analysts reckon that more than $1 trillion of additional global fixed income investments will be allocated to China domestic bonds over the next 10 years. Watch your KiwiSaver managers. Across the border from Hong Kong is the powerhouse southern city of Shenzhen, and housing prices there are falling and are now down more than 15% year on year. That realignment of price, however, has brought higher sales volumes, which are now up by more than a quarter from the same month a year ago. In Australia, the latest official data shows that Australian household debt in the March quarter equalled 190% of their yearly disposable income, a new all-time high. International trading in US Treasuries has the US 10-year yield up sharply again today and is now at 2.35%. These relentless rises are pressuring our swap rates, and they are likely to rise again after the US Treasury increase overnight. In fact, if all this passes through, we'll have seen a 20 basis point rise in the 2-year swap rate in a week, a 30 basis point rise for the 5-year and a 35 basis point rise for the 10-year. These are 4-month highs. If they keep going, we'll be in significant and market-turning territory. The price of oil is also higher today, rising to just under $47 a barrel, while the Brent benchmark is now just on $49.50 a barrel. But the price of gold is down very sharply, slumping more than $20 to just $1,218 an ounce. The Kiwi dollar has slipped slightly against the greenback, now at 73 US cents. On the cross rates, we're holding at 95.4 Aussie cents and 64.2 euro cents. The TWI is at 77. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.